As you just saw, the euro took out that structural play very, very quickly. We saw that fast drop and very quick turnaround. The majority of that trade was completed within the first 5 minutes of the first 5 minutes post the decision. Following that, we then got progression higher moving into the press conference, which then achieved the 112.86 area, kept the move going right up to around about 2 o'clock, to the point where Mario Draghi then suggested that asset purchase program had been considered, and this then created a turn back in the euro. But ultimately, by that point, the market, being relatively bullish anyway, had completed the structure to the downside and moved back to the upside. So after that initial trade, your opportunities in the euro became somewhat limited then. You were trading in the middle of a range that we'd already been trading in, which then provided very few sort of large directional move opportunities. Scalp opportunities, absolutely, they were there. But after that first bit of movement, your focus then could start to move into other markets, namely the Bund, which at this point, or at least up until the press conference, had still not yet actually completed its move, not yet pushed on through those poor lows. And so that was now where the focus started to shift to, and the bidding up in the euro is starting to have a little bit of an effect on the Bund as well. You're starting seeing correlated markets pushing down on the Bund, and this then provides the opportunity to play that structural play in the Bund, which we'll go and have a little look at now. Okay, so what we've got here is how the Bund actually played this trade out. You can see the block that we mentioned on the left hand side, and you can also see the gap that was then to be filled down at 171.69. Now the Bund took on a very similar move to the euro. On that initial comment, you got a spike up, the potential of a dovish scenario of more policy action. You saw this spike up, but we didn't have such a clear technical structure, and so you didn't have a clear reason or place to be trying to get into this trade. You get the very quick reversal as that euro reversed, and you can see the correlation starting to develop between the two here. So as the euro then starts to rally, Bund's then starting to fall. We get the drop in the Bund, and this falls much like the euro rose up towards those 171.17s, so your first area of support. This then breaks, and the first drop after the break of 171.17, as you can see on the chart on the right, that first spike low is right onto the top of the block, right onto that top of your place to get yourself in. And this was the whole point on, yes, the break of 17s could be your more aggressive entry, but that can run into support quite quickly. And that was really important to recognize. If you're selling below 17, looking for a larger move down towards, say, 69, you have to recognize that you're likely to run into hurdles along the way, and that you could well get a bounce from those 95s. At this point, when it hits 95 and starts to bounce, we're not into the press conference yet. So there is potential still for Draghi to come out with much, much more to suggest more things on possible opportunities to add stimulus in the future, and that could provide a very dovish twist. So that structural trade, whilst it is now on with the move through 17, is not yet fully in play. Once the press conference then begins, and you'll see if you look at the annotations where trades are then executed. Once the press conference begins and we start to drop back down towards those 95s, that then presents the opportunities to get short, to add into a position between 95 and 85, looking for then that quick move lower. And you see it on that final spike down that you can see on the 1 minute chart on the right hand side. That drop to the low takes 3 minutes, and that moves from 95s down towards 65s in 3 minutes. Very, very quick move, and all of that came about as it broke out of that block, as it came through the 90s at that time, but then as it came out of 85, that was where the move really started to accelerate. And that's the importance of recognizing that block, recognizing that was the place to get in. If you could get in within that block, you could then get yourself a position that as soon as it broke 85, you could hold, and your thought process then should be, you're in, don't exit until it breaks 79, and once it breaks 79, you're expecting the quick move down towards 69. So your main target should be 69. The speed of the move down then is your indication to get out. We see much higher volume, delta drops on that move down. That's the flush, that's the stops, that's what you're looking for, and that's the breakdown of that structural completion. As all of those stops get pushed out, that provides you the move and gives you that exit down at 69s. But all of that, it was all about recognizing the move into 95s. To start with, when you drop below 17s, you got the bounce away, and then the second time round, anyone who bought it thinking that they got away with it buying those 95s are just adding to the shorts if you get inside that block. So that first bounce from 95 actually helps you out on the wider trade. It just means that anyone selling below 17s actually gets quite a hard time and can be sitting in a relatively nervous trade waiting for then the larger move to actually play out. But that was the main trade, and it was all about understanding that move into that block that provided you with that opportunity, and that's your structural completion trade. So make sure you're thinking about those situations when you go into any of these central banks, because they can provide often a bigger trade. In this event, we didn't get any new information. We didn't get anything new in the press conference either. The tone didn't really suggest anything, and that's then where you don't just sort of step back and say, oh, okay, we've not got anything from this central bank, there's no opportunities. This is where you can start then leaning on your structure and leaning on other trades that may well come to play, because there is so much more volume. If you look at the volume on the hourly chart, look at those volume histograms, much higher than anything on the prior 4 days. So that extra volume, those extra participants, is what creates the movement, and that's what you're looking for these structural completion trades. We'll go on now and we'll have a look further at more technical trades, beginning with a position squeeze. Okay guys, so on to the second technical play that you get over a central bank, and this is a position squeeze trade. Now, the whole premise of this move is that the market is pre-positioned, either pre-positioned for a technical play or pre-positioned in the expectation of the central bank doing something, of acting in a certain way. So you've got two different types of squeeze here. First up, you have technical plays. So people have got themselves into a position, perhaps, for example, trying to play the breakout of a wedge. Now, the idea here is that you've now got people, say, short at the bottom of a wedge, looking for that move to go down. What that then means, and this is similar to the play that you got in the euro that we discussed over the ECB. What that then means is you've got a lot of people who are in a position with quite tight stops, essentially not wanting to take too much risk on this trade. What can then happen is you get a stop out of those positions, there's your squeeze, and then the move continues in the way that it was going to go. So that's your first way of looking at it. The flip side of that is, rather than people having positions for a technical play, a sort of technical breakout type move, is more where you've got a directional move into the event, into the central bank decision. And then what happens is it's not so much a squeeze of the positions going into it. So say, for example, you get a move up on a play for a certain central bank decision. What that's showing you is that people are positioned now long going into this. What would you do if you were long going into a decision? Well, on that decision, if you get the decision that you're expecting, there's your chance to get out of the trade. So you're using the liquidity of the new buyers that come in on the release of that decision to get yourself out. What this then serves to do is create a spike in the direction of the original move, and it's the new positions that enter on the perceived new information from the central bank, which ultimately it is confirmation of new information, confirmation of that decision. Those new positions that jump in then get squeezed in the opposite direction as the traders who already have their positions use those new entrants as liquidity to exit their existing positions, and it's then the new entrants that get squeezed in the opposite direction. So what we'll have a look at is I've got two different examples here, both over the Bank of England, and one example of positioning going into it, whereby that positioning is then the move plays into that positioning's trade, and you then get the squeeze in the opposite direction. And then the alternative, where you have a technical setup positioning for that technical play that is then squeezed in the opposite direction before that move completes in the same way. Now, considerations for these type of trades. In your planning of any of this, or a trade like this, and you can plan for a trade like this, in your planning for it, what you need to be thinking about is, where are those positions going to exit? So the positioning of the market, what are those people going to do? So put yourself in their head. What would you do if you had that position? So where would those people get out? And also, in doing that, you're answering the question of where could that squeeze reach? So, for example, you may have short positioning and a level a fair bit higher up, commensurate with a standard sort of central bank type move. So if you're looking in the pound, for example, something between 60 and 100 ticks higher perhaps, you could be looking there and thinking, okay, well, maybe that's where the squeeze could go. The stops could get dragged out up to that point, and then we can turn around. Now, that's giving you a little bit of scope, a little bit of an idea of where you might want to try and execute a trade. The next step is, how do you execute that? And you've got one of two options here. First up, and this is more a case where you have a technical type positioning, is a fade. The idea of the fade is if you get a rush against that technical positioning, that's going to jump to a certain point and give you the opportunity to go straight against that move. There's your first trade then, and so that's a very quick, as we've talked about before, quick jump up, sell into the move as it goes up. The important thing here is that you don't get anything from the central bank that is overtly out of line. So you don't really want a binary trade situation. If you have a very binary type trade situation, that could completely change the dynamic of the market. So that's your first opportunity. The alternative to this, and the perhaps slightly safer route, is to go for the reversal trade. So once the squeeze has happened, you're then using that information, that inability of the market to keep a move going in one direction, as your reason to play the reversal. You've got a couple of different options here. First idea is going to be a move back through the scene of the crime, so back through the point where the move began. And that's quite a common trade to see over a central bank, where people jump on the first piece of information, and then as more information comes out, the interpretation changes, and that takes the market back through the scene of the crime, back through the point where the initial move began. That's your first reversal idea. The alternative to that is waiting for an access point to develop. You're not going to know exactly where that point's going to be, and so pre-planning that isn't really something you can do. But what you can be thinking is that if you get that squeeze type move, there is going to become a point that allows you into that trade. I'll try and talk that one through when we go and have a look at the technical squeeze and reversal in the coming slides. So let's go and have a look at the first example of this, and this is a move over the Bank of England, where you have had the market position itself into the decision. So let's go and have a quick look at that. First up, we're going to have a look at a situation where the market has positioned itself into the event. So what you can see here in the pound is that we've had quite a rally going into the Bank of England decision. Past 3 days, and including the morning of the decision, the market has rallied. We've moved up from around about the 139.40s all the way up to around about 142.30, so around 300 ticks of upside activity. What this is suggesting to you is that people are playing for this move. They're getting themselves into long positions in the expectation that the Bank of England is going to suggest that potentially rates could still rise in May and give some kind of indication as to how that's going to happen, potentially vote in accordance to that as well. So we're getting a movement into this. The other thing to take from the technical player here is that going into it, looking at the profiles, and what you can see here, you can see the profile of the move itself, which is the profile furthest to the right. The profile to the left in the middle of the profile chart is an indication that the market is becoming stretched. We've seen a close that is a long way higher, the close indicated by the red asterisks. This is much higher than where value was the previous day, which is down at 141, 42, 44 area. So the market's now getting a little bit stretched. Think about what that means for those who are in positions. If you're long, and perhaps you've been long for a couple of days, yes, the market's becoming stretched, but ultimately you're still on side. You're playing for the Bank of England to give a more hawkish decision. Now, what are people going to do when that happens? What's going to happen is, as the move jumps, as people buy based on the hawkish decision from the Bank of England, those who are already long are going to use this as an opportunity to sell, to exit their positions. And this is where the squeeze comes. The squeeze comes on those who buy on the decision. They buy on the decision, create the spike up, and then they get squeezed in the opposite direction as the market starts to come back. So let's go and have a look at the expectation. Expectation is 9-0 for unchanged rates, but still potentially an indication that they could hike in May. So 9-0 for an unchanged of rates. We've got highs all accumulated around about the 142, 22s to 27s. So that's going to be your area that if you get any jump above there, you're expecting people to start taking profit. The result is that you get 7-2 vote for a hike. So 2 people voting for a hike. However, the interpretation side of this trade is that they add the information that data is broadly consistent with February. So whilst 2 people are voting for a hike, currently data hasn't changed, and so therefore there is no reason to believe that they are likely to hike rates anytime soon. It is just a couple of members. So what you can be thinking here is those who have played long into this are likely to get out. Those who have just bought it on the 7-2 are now in a sticky situation, and this dynamic can add to the selling, giving you a target initially of back down towards 142.04, the previous day's high, and then back onto the top of value, which comes in at 141.44 to 46, which is also a previous high from a few days prior. So you've got targets. The hard part of this trade then is how to enter the trade, and we'll go and have a look at this on a 1 minute in a moment to see where exactly you could have got into this trade and how you could have executed the trade, as well as what to expect when you get in, because that's the other really important part, and particularly important when you're debriefing these types of moves. How exactly does that move play out? What are you looking for when you enter that trade? That way you're managing your expectations going forward. If you expect a move to take half an hour to play out because it's a passive continuation on a reversal, then you're able to sit with it. But if you get into a move expecting an instant reaction and a very quick move that puts you on side, you're going to struggle to hold on when it takes its time to actually play that move out. So that's the important thing to take from this. We'll go now and have a look at it on a 1 minute, have a look at where those opportunities were and how you could have played this trade. Okay, so here is the reaction that we got. The first jump up, we moved from 142.10 up towards around 142.70. There's your spike up. That's the reaction to the 7-2. That takes you through the recent highs at 142.22, 27 area. And that's where people are then rushing to buy. Those who are already long are going to use this as an opportunity to exit, to take their 300 plus tick winner. And that provides some selling pressure. The next element of selling pressure comes from that aforementioned piece that data is unchanged since February. So now you've seen the squeeze, you're starting to see the squeeze. People have entered and the market's starting to come back on them. Now what you've got to do is try and find your entry point. First opportunity here, and we tried to break this down into 3 opportunities. The first trade is a fade. As it jumps up, you can fade it on that very fast move. Now the difficulty with this is we don't have a great deal of reference point. There's no clear level that you can say that would be a good point to fade from. So that makes it quite a tricky trade. Your next step is then actually planning out an access point. How do you get into the next leg of the trade? Now what you can see is that the market falls back and starts to hold above the morning's highs. The morning's highs right around that level, 142.27. So we begin to hold that. And what you're looking for here is then a change in price action. You're looking for a little bit more pace to be coming into the market, more volume getting put through. And that gives you the opportunity then to play a breakout or a breakdown trade back through the morning's highs. And what you're looking for then is a relatively quick move down towards the previous day's high, which comes in at 142.04. This plays out rather swiftly and actually plays out in about 3 minutes. So there's your quick first move. But still, remember, we've now spiked to the upside. We've still got people who will be positioned thinking that you're going to get then a pullback and a progression further up. So we've still not seen all that positioning coming out. Remember, this is also a market that has traded up into this move. So you've got a lot of positioning long that are all going to have stops lower and lower down as the move starts to pull back. So your second trade then is to be looking for a passive entry. Previous highs, remember, were 142.22. So you get a pullback up there, and as long as we're not getting back above those previous highs, that's where you have an opportunity for a passive entry to sell as the market rises back up, with the intention then of running this right the way down towards the previous day's value area high and those previous highs at 141.46. That's your bigger target. Now the important thing to be thinking about here, or to be taken from this, is that this second wave trade is a trade that's going to take much longer to play out, and in fact takes around about 2 hours to actually achieve the move. The move's a full 80 ticks to the downside, but it takes 2 hours to do it. And this is something you need to have in your mind when you're taking these trades on. That yes, you can see the entry point, yes, you can see the target, but what often happens is then the middle part goes out of people's heads, and all they focus on is the idea that I'm in here and it's going to go here, and they view it as a straight line move. Now, it's a second wave trade. So this is going to have, the market's going to have slowed down. You can see that volume's fallen off by this point. So you're going to get a much steadier fall from here, a much steadier drift down that's going to take that little bit longer. Now, if you've planned for this and you're ready for it, then that makes an absolutely fine trade, because you're able to then hold on to it. And your particular point of confirmation is when it breaks the lows at 141.90s. They were the lows that we'd established on the back of the initial pullback before the bounce up to give you that passive entry. So once that breaks, then you're confident that the trade is on. That's where your confidence increases, and that's where you can say to yourself, this is going to work. Maintain your stop above the previous day's high, above 142.04, and then you can start targeting that larger move down. So that's how you'd be looking to try and play this. 2 opportunities predominantly: the breakout to the downside for that initial reversal trade, followed by then the passive entry for the much steadier continuation move. You can play this as a combination, that you get in on the first trade, cover some, and then add in for the second, or this can be played as 2 distinctly separate trades. One, the first squeeze of those initial buyers that buy at above 22. And then secondly, as a passive move for this steady continuation to complete the move all the way down towards 140, 146. So two different ways of playing that same idea. It's all about recognizing that people will have given up on their long positions as you get the spike up, use that liquidity to get out, and it's the new buyers who enter at the top of a range that are the ones that get trapped and they get squeezed back the other way. We'll now go and have a look at a technical reversal or a technical squeeze of positions followed by the continuation. So both reversal type plays. We'll go and have a look at that. This provides a little bit more of a clear fade point, a clear sort of reference point where you could fade this, and you'll see the difference in the nature of the market going into the event. So we'll go and have a look at that. This time, the Bank of England once again, but in August in 2018, a few months after this decision had been made. Here we're going to look at a technical reversal. So a reversal of people who are positioned for a technical trade as opposed to positioned in the expectation of a certain event from the Bank of England. So in this situation, you can see the very clear difference. No trend move into this, no directional play into this. The market has been sitting for a couple of weeks between 131 and 132. It's also developed into a wedge, which we're beginning to get towards the end of. And this is where the technical play first comes in. From the morning's trade, and you can see the entirety of the move here, but the morning's trade gives an opportunity to play the break of the wedge, which also coincides with an inside day. The previous day was an inside day, so as that inside day breaks below 131.19 and breaks the wedge at the same price, you've then got an opportunity for a short. Excluding the Bank of England from this is a trade that you would be looking to take. Good technical setup, provides reasonably tight risk reward that you're playing a breakout below the inside day through the wedge and looking then for a move into the consolidation that you can see on the left hand side of the chart, and particularly down to where the majority of the volume is in the 130, 60 to 50 range. So that's going to be your main target on this. Now what's happened so far in the morning coming into this decision is there has been a move out of the wedge that has tested down to 130.90. This is where positions are getting accumulated. People are trying to play for this larger move, getting themselves short below the wedge in that range between 19s and 90s, looking for the continuation and potentially for the Bank of England decision to help with that continuation. Now put yourself in those people's shoes. If you were short on the break of the wedge, on the break of the inside day, where would your stop be? Well, for most of these people, or for many of them, their stops are going to be back inside the wedge, back inside the inside day. And this gives you the clue of a potential squeeze of positions. That anything that turns back up inside this wedge, all of those shorts who played for that continuation, that breakout below the wedge, below the inside day, are likely to come out. And remember, you get lower liquidity over these central bank decisions, so that's potentially going to create a larger move to the upside as well. The added benefit here from a technical point of view as well is that you've got a reference point for this squeeze. You're likely to get people wanting to sell the top of that wedge, wanting to sell that downtrend. So a move back up towards 131.73 could well be your opportunity to fade, to sell any fast spike up for the move lower, assuming that you don't get anything overtly hawkish, for example, a rate hike or a very, very strong vote for, not a very strong vote for a hike, a strong vote for a hike and an indication that we would get further hikes in the future. So, in terms of expectation, what we're looking for here is a 7-2 vote for a hike and the suggestion that you're going to get 3 hikes over the next 3 years. So we're expecting a rate hike. and we're expecting 3 hikes to be indicated over the next 3 years. Now what you in fact get is you get a result of a 9-0. So no dissenters to this rate hike. Everyone votes for the hike. And this is what then squeezes those short positions out. The initial reaction is this is hawkish, squeezes the short positions out, gets the spike to the top of the range, and then reverses. Another interpretation element, much like the previous, is that they suggested that it would be 1.5 hikes over 3 years rather than 2, and that Brexit risks are still prevalent. And so therefore, the indication that hikes are going to be ongoing and perhaps more aggressive than people thought is no longer there. That's very important, and that's what turns the market back down. Once again, we'll go and have a look at this on a 1-minute chart in terms of picking out where you could enter these trades, where those opportunities were. What we'll then do is contrast this with how it actually trades on a ladder, because it's very easy to pick trades out from a chart. And this is where that debriefing element is so important. Looking back at how exactly it did trade, could you have got into any of these opportunities? So we'll have a look at it first from the point of view of where seemingly you could have entered trades, and then we'll go and have a look at it from a ladder point of view as to how exactly you may well have been able to execute those trades. So let's go and have a look at that short-term chart. Okay, so here what we've got is the 1-minute chart as well as the screen dump, the release of that information. And you see the 9-0 is the first thing to come out at the bottom. Remember, you read from the bottom upwards. And then you get a little bit higher up, the reference to the market rate power flatter than in May implies bank rate of 1.1 in 3 years' time. That doesn't suggest 3 hikes over 3 years, because we're already now at 0.75, so it suggests only 1.5 hikes. So that's where you get this fade opportunity from. Now, looking at a chart, your first thought is, well, you have the fade from the top of the range, up at those 73s. So that's your first trade. Jumps up on the 9-0, and there's your fade. What you then have to do, and we'll see this on a ladder, is the actual trade opportunity there comes more in this fast recognition of a range establishing between 131.50s to 20s. And we'll see that range then trade up and down, up and down. Next up, you're then looking for a breakout trade. And with a lot of these types of trades, it can take some time before you actually get the opportunity to take the trade on. And this is what I mean about trying to find your access point. It's not always going to be crystal clear where you can get into this trade. You can't plan beforehand where exactly you would want to get in. What you do know is there are some very key reference points. 131.10, for example, was the previous lows and the point where people were looking for this breakdown on that inside day and the wedge break. We'd also established lows at 90s for the day. So a break of 90s then accelerates this idea of falling. It also means that anyone who has bought it on the decision is definitely wrong. No one could have bought it on the decision and still been on side when you get through the low of the day. So what you're starting to look for then, and this comes into trade 2, the breakout element, is clues for this. And what you see is we have around about 45 minutes of sideways trade, but you get a very good clue that once we've established this range between 20s and 50s, is you then start to get quite this heavy sell-off. Comes a few minutes after the decision. Heavy selling back down once again towards 131.10. So we're seeing that the sellers are willing to take control here. Don't get any movement back up, and so the 131.10 then becomes your access point. We've tested it. By the time the breakout comes, that's been tested twice. You're looking then for your entry as it breaks through there. And as it breaks through, potentially a pullback and a stall there to give you a passive continuation trade. So that's your third opportunity. that you play in the passive trade as you break 10 to get in, still with the intention this is going to fall through 90 and then continue down towards that 130, 60 to 50 range. In terms of your exit, what you're looking here for is any exhaustion into that zone. So rather than putting a definitive this is the level on it, use the price action to show you where that level could be. So as you get this exhaustion move down, this fast drop into 60s, that's your clue. That's the place to be getting out of your trade, and that gives you opportunity to exit. If you want to hold on further, you can do, and we'll see that from the price action from the ladder, where exactly you could have held on to this trade, and some of the clues that you should be looking for, and some of the things that you'd be putting into your debrief as to how exactly this traded to learn from in the future. What I've done here is, if you look at it purely from a chart point of view, there seems to be some very easy and very obvious trades to take here. We'll see on a ladder how particularly the fade at the top of that range was a very, very difficult trade to actually execute. So let's go and have a look at that, and we'll go and have a look at how this was actually traded. Okay guys, take note of where the pound first starts. The video will stop in a moment and you'll see the initial spike on the very first release, instant up towards 75, giving you very little chance of getting in. Now what you can see there, and as the box showed, it was instant to 75 and straight back to 40. This meant that the only way you could possibly fade this was by having an offer there. So your next area of fade is to establish where the market's ranging. We've seen a trade up towards 50 and we can't then get beyond there. What typically happens after the first spike is we get a bit of trade that creates a small range. There again, once up more, up towards 50s, and we find resistance. So this range is now being established. 131.20s up to 50s. Remember, 131.19 was the breakout point. That was your inside day break. So we're staying just inside there, holding above 20s, trading up to 50. So if you're looking to play the long trade here, the continuation to keep the move going towards new highs, you have that opportunity. You'll be playing this trade as long as we're staying above 20s. You're looking then for a break of 50s and a continuation higher. But what we start to see here, we're just over a minute after the event. Volumes have started to fade a little bit. We've started to slow down. Once again, another push up to 50. Do we see any continuation? No. So what we've now got is a range that we're waiting to see the break of. Now, from a technical point of view, those shorts could well now have been viewed as being squeezed out, and we're then going to get new shorts established on a break back below 19s and 10s. So that's going to be your idea. If you are sticking to this technical view that we have a position squeeze up based on the technical wedge break, that position squeeze up, then we're looking for more selling as we come back below 19s and 10s. Whilst above there though, whilst inside the inside days range, we've still got scope to the upside. And also based on the slightly more hawkish decision from the Bank of England, we've still got scope there. So there we go, down towards 20s, and we're starting now to actually just have a little bit of a tip through 19s, 20s. Find support again. You now need the support to act and start giving us a buyers, bringing the market back up through the 25s where the average price is, back up towards the 50s once more. But what you're now starting to see here, it's struggled at 25. We've had another attempt at selling here. This could be your first attempt at the breakout trade to the downside through the 19s. If we can get through 10s, then you should get the acceleration. So here's the first push down towards 12s, 13s, and we find some buying quickly. Now the important thing here, if you're going for the short, is that we don't break 19s. If we get back above 19s, then your reason for the short is no longer valid. And also the more important element is you're looking for it to move back through 10s. We're not seeing that. We're now starting to tick back up above 19, and so we can now start looking for a move, particularly if we get through 25s, all the way back up towards the 30s to 50s area. So the first attempt is not there. That first attempt lower has failed at 19. We're now starting to tick back up through the range. And still a potential opportunity. Those who are long are still feeling they've got a little bit of comfort in this trade. They're still slightly safe on this, and we can still be looking for a further continuation up towards 50s and then potentially all the way up towards the new high. So we're back into that range and back consolidating once more. This is giving us a little clue. We're starting to establish a low that's important down at 12s, which also coincides with those previous lows where the main part of the breakout is likely to come from. So that's what we've managed to establish so far. Remember, these trades often can take a little bit of time before we get the next leg of the move, and so you get 45 minutes now before the next leg. The next video will show the final leg. Okay, so now we're going to look at the breakdown through 19s and through 12s, so the final stage of this fall on the chart. And this is your point where you've got the more aggressive break. The price action really tells you a lot about what's going on, but also from a ladder, what you can see, and you can't see this from a chart, is other areas where you can get into this trade. So currently we can see that we're starting to drop through 19s, no real aggression here, so quite a steady little move through 19s, but this is then getting out of a position here, so exiting the long position. We're not in this example actually going to see a new short position established. But what's important now is we've just ticked through 19s, still quite steady at the moment. And what you're looking for then is a bit of pace. You want to see some more pace as we get down towards 10s, and that's your indication, that's your signal to try and go for the sell. We're not getting any buying back above 19 either. So this is where you're building up an expectation of what you want to see happen and how you're going to get in. So you've got that 100 lot as well, sitting at 15s. That's another area you could be looking for. How does the market trade into that? If you get a bit more pace into that, there we go, 15s is gone. We're now trading down to 10s and straight the way through there. So we've seen that little pickup in pace. You could have had the aggressive trade through 10s. What you've also got here now, or should be thinking about, is the passive entry. Anything back up towards 10s is an opportunity to sell. So you trade back up, 6s bid, 7s. Here's your opportunity for a sell. As long as we're staying below 10s to 12s, we've now got more scope to continue this move, and your next phase is then through 90s. So there was your passive sell opportunity as it slowed down. That's the important thing. Once you've got a move that starts to go where you're expecting that more aggressive move, what you need to be noticing is not about where can this stop to the downside, where is it stopping to the upside. Well, each time it stalls, so now you're seeing it stalling around 2s, 3s, there's the area where you should be viewing resistance and think to yourself, as long as we're staying below here, I'm valid to stay in this move. So we've had the breakdown through 10s, you've also had the passive entry opportunity through 10s, and now what you need to be looking at is the rotation that we're seeing in this market. Back up to 2s, 3s, no buying through there. And so now we're looking for a continued move to the downside. 90s is the important level. Once through 90, that's where you're expecting to see acceleration. And there we go, quick snap through 90 down towards 86s. So now you should be thinking, okay, as long as we're below 90, I'm all good. We got 270 lots traces, nearly 300 lots on the offer now. Can this keep the market going down? No one buys through it. That's showing that the sellers are still strong as well. So in your mind now, we're looking down to 60s and 50s. Even though that 300 has been filled, we don't then get any further buying above it. We trade 81, 80, 81s, still no further buying. That's another good sign for the shorts here, suggesting that there is still some selling in this, and you're now looking for, as long as we're not rotating back above 82, 83, you can stay with this further. Little bit of absorption down at 76 is there. Market holds, and this next time we go there, we start pushing through. So we are still seeing a little bit of trickiness here. Yeah, this is where you could be in doubt of the move, but the important thing, like I say, with a move down is that you're looking at where it rotates back to as your reason to get out, not trying to establish a reason to get out too early. There's your quick snap down. That can give you your exit. We expected 60s to be a target. You then finally got this very quick whip down towards 60. That's the exhaustion. It's the exhaustion of people selling. It's those who are trying to get on the move, They quickly or they panic. There's urgency to sell there. We're once again getting rotation back to 67 though. And so you've got a reason to exit now. That's what you're always looking for. Rather than looking for a point and saying to yourself, oh, it's slowed down at the lows. What you want to be looking for your exit is that exhaustion, that washout type move. And that very quick snap through 70s down towards 60s, which was a target area, should then be enough to exit. And you've got to accept you're unlikely to get 60. More likely what you're going to get is as soon as it snaps to 60 and starts to bounce, that's where you try and exit. So you might be getting 63, 64 on this move. But that's how you want to be trying to get into this trade, or get in to start with as we move through 19s, as you get that passive test back up towards 10s. That's your entry point. From there on, it's then a case of watching the rotation. So we held 3s. We then dropped further. We got 300 lot comes on the offer. That was filled, but no trade above it. So then 82, 83 becomes the key area. That way you can then continually move your stop down rather than just get out because it's perhaps stalled, and it did stall around 76. Rather than just get out there, you're then continually just asking yourself, where do I need to be bringing my stop down to? Where can we not rotate back above? Once more, we're having a little test now through 57, 56. So we're down into that 50 to 60 area. If you are trying to hold on to this move and you are trying to bring your stop down, anything back above 62, 63 could be your sort of soft stop on this. We're still seeing here a little bit of battle. There's an attempt at selling 62. The bids are becoming stronger here now though. And so you're getting a sense that maybe this is the end of the move short term. If, however, you are going to try and hold on to this for a much larger move, then your stop can still be above 80, where that large order traded, where we couldn't trade back through. And as long as you keep your stop up there, you will then be able to stay in this move and let it run all the way down and through that wider range. So a couple of different ways that you can enter or get onto that very fast move down. You had the aggressive move through 10s, you then had the pullback to 10s, and all this comes from the fact that you've seen the clue, you've seen the market start to build this range higher up between 131.12s up to 131.40s. We got the heavy selling clue that brought us down from the 40s back down to 12s the second time, and it was then on a third attempt at 12s you don't get any further buying, and that's the one where you can go for the short. That's also the point then where those who originally sold it and had sold it in the morning and got down to 90s are then likely to come and re-enter that trade looking for that continuation move and that move down to their original targets. The final technical play that we're going to look at is a continuation play. Now, what I mean by this is a technical setup that, in the absence of the central bank, would be the direction that you would be most likely expecting the market to move in. The path of least resistance, for want of a better word. So, in which direction is whatever market you're looking at going to go and run into less and less hurdles to a certain move. So say you're looking for an upside move, what you can then be thinking is, okay, if anything from the central bank comes out that suggests an upside move, then you've got a more likely move coming. What this serves to do is lower your tolerance for reasons to go for a certain directional move. Whereas if, say, you have central bank decision that goes counter the continuation structure in the market, then that's going to be a move that's likely to be harder to work out. And this is where you're then going to be moving more back towards perhaps a position squeeze type trade or a structural completion trade. The other thing to think about with a continuation trade is these are not always ones that play out immediately on the reaction. Some of them often can then play out over the coming days. So don't lose sight of the bigger picture when you're looking at these type of continuation structures. So the whole idea of looking for a continuation trade is to, in a sense, bias your conviction in one direction. What you should be looking for is, like I say, if any part of the decision tips towards the direction of least resistance, that's going to be a trade that you can have much higher conviction on, one that you can execute more size on, one that you can be more willing to hit and hold. The other thing that it does for you is allows you to differentiate between markets, to decide that you're going to trade a certain market over another one. So if you have a decision from a central bank that would create a bullish move in both, but one of them has a much clearer bullish structure, so is more set for a continuation of its current move, then you're able to choose that market, the one that's going to provide you with perhaps a more sustainable move over time, perhaps a stronger initial move as well, one that is less likely to start pulling back on you. Whereas if you've got a market that is going to rise on a certain decision, but that in rising it is going to run into resistance followed by resistance followed by resistance, then it becomes a much harder thing to take on, or a much harder trade. You're getting into a trade that is at numerous points going to get pushed back on you, whereas the market that has very little resistance and is already set in that direction is going to find it much easier to progress through levels, or in fact in many cases actually doesn't have any levels that are going to provide any resistance for it. So it allows this differentiation. I'll show you and I'll give you an example of this. We'll look at the S&P versus the T-note over a Fed decision. Both should go in the same direction, but the dynamic between the two as to which goes first, which stays in a certain direction, is very clear. And having considered the market structure beforehand, you can be looking for which one you're more inclined to play as that continuation trade. Now, in terms of the continuation, it's not just a continuation trend following idea. This could be a continuation of a reversal. So a market that has begun a reverse, and you're then looking at reasons to then start to play perhaps a slightly more passive trade to then try and play for a continuation of the reversal that's beginning to develop. If you're looking for a trend continuation type move, then it starts to give you a slightly different trade style or execution strategy. If you're looking for a trend type continuation, then this is where you're going for a more of a break of a certain technical reference. This should then open up a much freer, much steadier continuation type move, which means that the onus then goes on to a slightly more breakout style, a trade where you need to get in, position yourself, and then try and maintain that position for a larger and more steady move. We'll go and have a look at two different examples of this. One, a reversal type trade, and secondly, then a continuation trade. Also, with the consideration of the difference between two markets, one that's more set for the continuation and one that's less, and you'll be able to see the difference in how they trade. So both examples, we're going to use the Fed for this. First up, we're going to have a look at the S&P and a reversal trade and a continuation of its current reversal pattern. So here, we're looking at the Fed from 26th of September 2018. And what you can see, looking at the S&P, is that we've had a relatively strong move up. The chart on the left is a daily chart of the pit session. The chart on the right is a 24 hours chart on an hourly basis. Now what you can see here is that we've had a gap down on the pit session, and we've now fallen back into a range in the S&P between 29.30 and 29.17 approximately. So we're into a reversal situation. The market's traded up, we've gapped higher, and we're now starting to fall back. We're falling back onto recent resistance at 29.17, and we're into a small range. So what you'd be considering here is the ability of this market to continue the reversal pattern that it's showing. As shown by those green arrows, if we can exit the current range from 30 to 17, we're then set up for the possibility of a move then down towards 29.07.5, and even further then down towards 2900, and even as far as 28.93. That's more the direction that this market is set to go in. We're trading mid-range at the moment. We've already filled the gap, so we have no great reason to go higher in this one. So anything that gives any reason to go higher is a situation where the S&P could then use that to set up a move to the downside. And any move out of the 29.30s to 17 range to the upside, any move back inside then sets up the move through the range and then a break lower. So your continuation idea here is that you're looking for a continuation of the current reversal type pattern. Execution wise, you're either going to be looking for passive entries as the market rises, or alternatively you could be looking for a more aggressive breakout entry as we move back through the bottom of the 29.17 range, and then targeting a larger move down towards 29.07. So that's going to be your plan going into this, that your tolerance to get into a trade is going to be lower if it's a situation that gives you the opportunities to sell, whereas your willingness to go long is going to be that much more diminished because of the fact that there's quite a lot of hurdles to a continuation upside within a market that is already beginning to turn back. So let's go and have a look at what was expected so that we can see what could have created an upside move, what scenarios could have created a downside move, and then we'll go and have a look at the actual reaction. In terms of expectation, we're reasonably limited. This is September 2018. The Fed is in a rate hiking cycle that has been very well telegraphed. The dots have linked up with coming rate hikes. So most people are reasonably comfortable with where they expect rates to be going. So the actual hike that's projected is not the surprise for the market. The market's fully pricing this in. They're not going to be surprised by the rate hike. The area of particular interest is then going to be around the dots, whether they could change. And again, the expectation of a dot change is very minimal. The other key area where they're expecting some kind of change or looking for a potential change is the Fed's use of the language accommodative. Now, the Fed describes its monetary policy stance, or at this point in the cycle had been describing their monetary policy stance as accommodative, meaning that whilst they were raising rates, they were not raising them at a pace that would inhibit any kind of growth in the economy. So that was their accommodative stance. Now, the change that could come about is they could drop the accommodative stance. Initially, that would be seen, you would think that's perhaps a more hawkish view. They've dropped this accommodation to the economy. However, the idea of the dropping of the accommodative stance suggests that they're moving to a more neutral stance. A neutral stance means that the Fed has reached the point where they see no reason for rates to change up or down at any point in the future, or any point in the near future. So from this perspective, the opportunity is then that they could drop the reference to monetary policy remaining accommodative, and then change that language to monetary policy now being neutral, suggesting that this is the last rate hike of the year and that they would not have a rate hike in December, as the dots are currently expecting. This would also imply that dots would then have to be changed going forward as well. But that was what was being looked for here. So your dovish scenario is that the Fed drops the accommodative language, puts in neutral, that creates a bullish move for the S&P. But with this being a market that is already showing a reversal, we need to see a pretty good, solid move to neutral and potentially a drop in the dots to really progress this move higher. Now, looking at the statement as it comes out, you can see that they raised rates. They removed the description of monetary policy as accommodative. However, they did not go as far as to introduce the reference to neutral. So what this means then is you have a reasonably dovish outlook and an argument for the S&P to go higher on the basis that accommodative has been dropped and neutral is the likely next place to be going. However, we've not yet seen the introduction of neutral. The dots have still stayed the same, so a rate hike is still there for December. So you've got some relatively bullish news, but for a market that's not that bullish and it's exhibiting the potential for a reversal, this is not necessarily the greatest news. We'll go now, have a look at the reaction and how this reversal trade actually then started to play out over the course of that evening. What you can see here is a 1 minute chart of the reaction. You can see where the volume picks up, and that's the initial release. That was the point where they dropped accommodative and you got a slightly bullish move up in the S&P. Moved the market from 29.27s up to around 29.33s. Now remember, from that previous example that we looked at, or the previous larger time frame chart, this is then taking you out of that wider range, up towards the closing gap that we talked about that had already been filled. So we're getting a test out of that range. Now, whilst the news was relatively bullish for the S&P, it didn't have that introduction of neutral, so it didn't provide the very strong bullish information that you may want in order to be willing to go long against the current reversal type trend that is being set up. So it's then a case of, okay, you may not want to be long, but there's no reason to want to be short at the moment either, whilst you're outside of that 29.30 to 17 range. That's the key area. And with a lot of these continuation trades, they often play out a little while later, meaning that you don't have to be the fastest finger first. You don't have to be jumping in on the initial reaction. But the overall technical structure of the market then will tend to play out as the day progresses, particularly without any major change. And there was no major change here. There was a beginning of a change, but not any kind of major full-on policy shift. And this is where that continuation of the reversal play comes in later on. So what you're looking for here then is clues. How are you going to get a short opportunity? Where is your access point? How can you play this trade, and what's suggesting to you that actually, yes, this trade is on? So first up, after the initial move up towards 33.5, we then get a pullback towards the top of the old range at 29.30s, followed by one more push higher. That second push higher then fails. And where you get that clue to the failure is that we drop back below the initial high, retest it at 33.5, and then start to fall. There's your clue. That doesn't necessarily mean that you have to be short from there. What you can now be looking for though is if we get back inside the range, 29.30s down to 17s, then you have the opportunity to play a short, possibly as a passive continuation type trade, as illustrated, that once you fall back into that range, so you fall back below 29.30, you've got an opportunity to go straight away short as you come back into the range. Alternatively, you have a passive entry back below 29.30, looking then for the continuation all the way through the range. This should take you then down towards 29.17. And the other thing to be considering here, remember the overall structure that we had on the hourly chart. If you get out of that range at 29.17, you could then see a further acceleration. So even if you're not in from 29.30, even if you don't trade it until we get that little bit lower down, the move through 29.17 is the point where everyone who's long in the range of 29.30 to 17 is then wrong. And that's where they're all going to start to exit the trade. So you can actually get a greater acceleration as the market falls, as opposed to getting in for the much steadier move down. With a lot of continuation trades, they will often begin as a rather steady move, and then this will pick up pace as the move goes. So that's what you'd be looking for here. It's all about, with these continuation type trades, assessing where your access point is, choosing a point where you realize that the continuation move is now on. The market perhaps has tried a move higher and failed. In this instance, you get a clue to that failure when we can't get back above 33.5. You then get a passive entry opportunity at 29.30, followed later by a more aggressive breakout opportunity as you break the bottom of the range. You're expecting an acceleration, and that acceleration takes you in 4 minutes all the way down to your larger target down at 29.07s. So the continuation type setups provide you numerous opportunities, numerous ways to get into the trade. It's something that you can take your time on, but make sure you maintain that overall view. It's something that gets lost often when trading events, trading a central bank decision, that the focus goes too much onto the immediate, what's happening right now, and ignores the larger scope that the market may well have. Once back below 30s, this market had a scope of perhaps 25 handles to the downside. That's what you should be maintaining in the back of your mind, maintaining that idea in your head that you could well see this much larger move. What we'll do now is we'll go on and have a look at a decision in 2019 and the comparison between a market that is more set for a continuation and one that is much less set for it, and looking at how the hurdles to the move up apply to one and a little bit less so to another. So we'll move on to that and we'll have a comparison of the S&P versus the T-note. For the second example of a continuation type move, what we're going to do is consider the difference between the T-note and the S&P. The S&P, the market exhibiting a more reversal type structure, whereas the T-note, as you will see in a moment, has a much more clean, bullish continuation type structure. As you can see from the S&P, the chart that I've got here is a 60-minute chart on the left and a profile chart on the right. Much like the last example, the S&P has been rising and has then failed to continue higher, fallen back below a previous resistance at 28.41 a quarter. Once again, sitting in a range as well, has actually in this case broken down through that range, down through 28.26 and 3/4, which then sets you up for a move towards 28.08.5 and a little bit lower down towards 28.03s. So that's the situation that the S&P is sitting in. You can see very clearly from here that a more hawkish Fed would give a better situation to then start to fall here, to continue this reversal play that's been put in. There's an argument also that the S&P has a head and shoulders pattern there as well on an hourly point of view. And so from this perspective, as long as you're staying below 41.25 and at a very last push using the profile, the VPOC up at 48.75, as long as you're staying below 41.25 predominantly though, this market does have a more bearish outlook, meaning that you're going to need a more hawkish Fed to then get the you're going to need a much more dovish Fed to keep the move going. A more hawkish Fed would give you conviction to trade the S&P over any other market, as this is the one setting up for the most bearish type reaction. So that's what we're looking for the S&P. If we take it over to the T-note, you'll see a somewhat different structure and a market that is much more set for a move to the upside, and so is much better placed for a dovish reaction, whereas the S&P much more better placed for a hawkish reaction. So let's go now and we'll go and have a look at how the T-note is setting up into this and the relevant levels that you'd be looking for there. Now the T-note is sitting in a sideways range, so somewhat balanced. What this does mean is that a breakout in either direction is likely to create quite a larger move because of the energy that's been built up in this range. Now, when we go and address the larger time frame, the daily perspective, you'll see why a move to the upside is perhaps the slightly more favoured move. But nonetheless, currently the range in the T-note is approximately 122.31 down towards 122.21, so a 10-point range. In terms of clues here as to which direction the next move could be, this is a market that's starting to tip towards the upside. A market that is breaking a trend, is trading up around the 122.31 area. If this can break, then we're setting up a continuation to the upside. For the move to the downside, similar to the last one we looked at in the S&P, we'd want to see a failure up here and then a move out of the range to the downside. But as you'll see in the next slide, you'll be able to see that the upside structure is that much stronger for the T-note, and we've actually built a reasonable base to be resting on to help with this continuation to the upside. So here is a situation where a more dovish Fed, or even not a massively dovish Fed, but a slightly more dovish outlook from the Fed, is going to be a lot easier, and your willingness to play that trade in the T-note is going to be much greater than it might be in the S&P, which doesn't have so much setup or so much structure for a continuation of its current upside move. So let's go and have a look at what the daily perspective is on the T-note. This gives us the reason to believe that there is a larger move to the upside, and also the next reference points that are going to be needed to break to maintain this move over not just the rest of the evening, but also over the coming days. What we've got here then is a daily chart. What this is giving you is the T-note over the past 18 months. The middle of that chart is the entirety of 2018. You can see the scale on the bottom. So the entire range of 2018 was essentially between 118 and 121, reasonably tight range for the T-note. Coming into the back end of 2018, the T-note did then start to rally, and into the beginning of 2019 has then consolidated at a higher point. Coming into the March meeting then, and you can see now why we've got that slightly more bullish outlook. The range established on a shorter time frame is a range just above the wider range that stops at 122.22. So the current range is actually then basing above the larger daily range. That's what gives you the slightly more bullish outlook. That if we do start to fall, any drop is just going to move back inside that wider daily range, which is then likely to provide more support, particularly as this is a consolidation on the back of a move higher. So that is your first argument to be looking for a more dovish Fed, or to be more inclined to be trading a T-note with greater conviction on a more dovish Fed. So from then, what we need to be considering is what hurdles do we actually have to the upside? And as you can see, very, very limited. there aren't any levels that were traded in the entirety of 2018 to the upside from here. So going back to the end of 2017, what we have got is 123.08. That's a mid-range little bit of resistance. So that's going to be one area to be watching out for. But as you can see from the more recent trade, the main level to be looking for is the recent high, which comes in at 123.18. That's your key level to be looking for. And that's your real key reference point that you would be looking to break, then for a much larger continuation. Now, this doesn't necessarily have to happen on the day. For the T-note to move up nearly a full point, that's quite a big ask. To then break and continue is an even larger ask. But it's something that you should be bearing in mind for the following days afterwards, that if we do get anything relatively dovish from the Fed, this then sets you up a situation where we could see further continuation, and you could be looking for a more bullish move all the way through that box from the left hand side of the chart. Because you've had a grind down, and this is a key part of technical analysis, any move that falls in a grind doesn't provide a great deal of resistance on the way back, because as each small level established within that grind breaks, that gets a few people out and a few new positions long, and in doing that moves you up to the next small level, and as that breaks you then get another entry of new longs, exit of some shorts, and that takes you up to the next level. So you end up breaking levels by virtue of people trying to enter trades, and so this then can create quite a steady and smooth move through that previously grinded or ground down section, meaning that above 123.18 there's pretty reasonable scope for a steady continuation move right the way up to the low volume at 125. So this is a market that's got very few hurdles to the upside, those hurdles being 08s and then 18s. And then beyond that, a good argument then to move steadily higher all the way up towards 125. So this is the market to be looking for if you get anything of a slightly dovish nature from the Fed. And even if you had anything that wasn't majorly hawkish, this is still a market that if you took the Fed out of it, you would be looking for a continuation to the upside. And that's the important bit. Ask yourself that before these decisions as well. If we didn't have this decision, where would I expect this market to go over the coming days, weeks ahead? That can help you out in determining which direction is going to be more available, which direction is going to have the least hurdles to a continuation. So we'll go now, have a look at the expectations so that we can actually see how we'd be expecting this to react, or which market you would be wanting to play on this move. Dynamics had shifted coming into the March meeting. Since the September meeting that we used in the last example, the Fed had raised rates in December, much to many market participants' disappointment. Dynamics had shifted coming into the March meeting. Since the September meeting that we used in the last example, the Fed had raised rates in December, much to many market participants' disappointment and slightly against how the market was pricing. What they then did is pulled back on any further potential rate hikes and introduced the word patient on any kind of future changes in rates, suggesting that they were going nowhere anytime soon, and that a move to the downside, i.e. a lowering of rates, was just as likely as a hike in rates. Furthermore, they dropped their reference to the outlook being roughly balanced, a long-term used signal or tagline from the Fed to suggest that the economy was growing as expected, that it was roughly balanced. And they also removed the referral to rates to follow a path of gradual increases. So really taking away a lot of the hawkish outlook for the Fed, putting them very much onto a neutral stance without using the word neutral, and suggesting that actually perhaps the next rate hike, and this is the way the market took it, that the next rate hike was more likely then to be a cut rather than any kind of hike, despite the implication that patient means that they could go either way next. The swift move towards patient was an indication to the market that actually the next move was potentially more likely to be a cut than a hike. So in terms of rate expectations, or expectations full stop, no expectation of any kind of change in rates. So 2.25 to 2.5% was the expected rate. Expectation was also that the language referring to any further change in rates, the Fed would remain patient in their decision. And the big one to be focusing on, and this we've looked at previously, the big focus is the dots here. That's the guidance as to where the Fed is likely to be going for the rest of the year and coming years. So, across the board, expectation of dots to fall. Now, for 2019, there was an expectation of a drop of one hike. So the dot would then come out at 2.6, suggesting that you would still get one more hike this year, but that would be it, as opposed to the 3 hikes that people believed were going to come when we were back in December. It would be a very difficult thing for the Fed to shift to no hikes for 2019 because of the number of voters that would have to vote for that. So that would be really key. 2020 dot was expected to fall to 2.8, 2021 dot equally expected to fall to 2.8, and the longer run likewise to 2.8. So that was the situation that you were sitting in. The opportunity for a more dovish play would be if the dots get dropped further, if potentially the Fed cut rates. That would be a very big surprise. The other things that could come into this as well, balance sheet runoff. So this is the reinvestment program that the Fed has, and the idea of them stopping that reinvestment program. So whilst they were reducing the amount of money that they reinvested from their asset purchases, there was then a coming sense that they may well stop this, and stopping it sooner rather than later would also provide a dovish boost. On their reference to inflation and their other economic projections, there was an expectation that inflation would still be expected to be higher as we went out into the future, no change to unemployment, and also then GDP down by 0.1%. So they were the sort of additional bits, the specified binary, or the variable outcome trades I should say. The specified binary trade was on the dots as to whether we would get this in line or the severity by which they get dropped. 2.4 for 2019 would be an extremely dovish signal here. So that's your expectations. What we're going to have a look at now is the actual result of this, and then we'll show you the difference looking at price ladders as well as to how the S&P traded compared to the T-note. Remember, the T-note is the one that is set more for a dovish move than the S&P, and likewise any kind of hawkish news would likely pull the T-note just down onto support levels that it was already sitting at. So we'll go and have a look at that now. The Fed decided to really go for this, and they left the rate unchanged, but the big thing they did change were the dots. And contrary to the expected difficulty to actually shift the 2019 dot down by 2 hikes, i.e. suggesting no hike in 2019, they managed to do. So this was the first thing to be watching out for. End of 2019 dot down to 2.4. The 2020 and 2021 dot also fell further than expected, not to 2.8, instead they both fell down to 2.6. It was only the longer run dot that remained at 2.8 as expected. The Fed also brought in a suggestion of the balance sheet runoff beginning in May and running to September, so therefore balance sheet reinvestments were going to maintain at the same level that they currently were, or they're only going to reduce by about a marginal amount. And in terms of the forecasts, GDP to stay the same, longer term inflation that was expected to be upped actually didn't move at all. So even there, they're suggesting that even down the longer term, that rates are still, well, that inflation is going to stay low or in line with what they're expecting. So there's less reason for rates to go up anytime in the future at all. So pretty big shift, very much onto the dovish side. And so this is where you're going to be looking to take on the T-note trade, to be trying to play this for a continuation move, and remember, up towards those 123.18s, and then for a much larger continuation after that. The S&P, on the other hand, a market that, whilst this is very dovish news and should definitely go higher, is then going to run into difficulty as the market rises, and that's the difference between the two. The T-note is more likely to provide a freer and more smooth, steady move up, whereas the S&P is going to run into obstacles all the way up very, very quickly. So we'll go now, have a look at a video, have a look at how these actually traded, and you'll be able to see exactly the scenario that played out. Okay, so we've got 20 or so seconds until a decision. Now remember, the big focus is going to be on the dots here. That's the main thing to be watching out for, and whether the Fed can drop the dots, particularly in 2019, to 2.4. That's going to be the big change. We've got the S&P trading around 28, 26, T-notes trading around 122.29 currently, and we're about to get the decision. So here it comes. There we go. Dots cut 2.4, 2.6, 2.6 for the 2020 and 2021. So much bigger cut than expected. The T-note jumps instantly above 123. Bit of a pullback, and then starts to trade higher once more. The S&P again also whips back towards 30s before starting to continue. Now you start seeing the faster move coming in. T-note's now pushing for its highs. S&P struggling up towards its highs. Now remember, S&P was the one that's perhaps slightly less set up for a move higher. The T-note at this point is now pushing up towards the 123.08. So very clearly got out of the 122.31 range up towards 123.08. That's the first area of resistance that you're looking for. We're seeing the S&P having multiple pullbacks. Really, we've not moved very far from 28.30s. The T-note very much holding on to the initial move as well now, whereas the S&P, we're still trading around similar areas. The T-note has pushed on up from 30s up towards 05s, 06s. The S&P once again back towards 28.30. We've seen a lot of washing back in the S&P. Comes back to the area of high volume around about the 28.30 and a half. There's 27,000 traded, you can see in pink. So very high volume trade there, and we are staying above there. So from the S&P point of view, it's still got a valid move to the upside, but it's struggling in its nature. Whereas the T-note, if you've got in, because this is more set for a move higher, it's a market that once it started the move is then sustaining this move right at its highs. No real pullbacks. We're seeing 3,000 lot chases up and pushes the market right up towards those 08s. You note as well, we've got 6,000 lots sitting at 08s. That creates a bit of resistance. It's already a resistance level anyway. So the large order is then capping the market right at a point where people would perhaps be considering taking profit anyway. So from that, you're then going to get this slowing down in the T-note because you've hit a decent resistance. Also, there's a large order there. So if you were long, think about what you'd be doing. If you were long going into this, you'd be looking at that large order and thinking, okay, maybe we'll take some profit here. The S&P now breaking through the highs around 28.36. We get this quick little push up, rather low volume traded around 37s, and this allows the S&P then to keep the move going. Whereas the T-note now starts to fall into a consolidation. But unlike the S&P, you're not seeing the T-note pulling back very far. And that's the distinct difference. Where the S&P, as it moved up, it would have quite big washbacks each time it pushes on through the highs. So now trading 39, it then still washes back. Even if it's only a handle or two, it's constantly not sustaining a move up. It's always washing itself back, washing itself back. The T-note, on the other hand, back up to 08s, sitting rather steady up in that area. And what you can see, as you can see from the charts, the T-note then goes through a phase of just consolidating, building value up at these higher areas, but ultimately doesn't pull back any more than about 2 full ticks. So it stays very, very stable, very rigid towards the top of its range. Whereas the S&P, if, for example, you were buying this as a breakout type move, the S&P continually pulls back on you. So if you try to buy this into the high each time, the S&P is then going to start pushing back. And this is because you're running into hurdle after hurdle after hurdle to the upside in the S&P. Main focus at the minute for most people is going to be 41.25 in the S&P. For the T-note, what most people are going to be looking for here is a break through that large order. Once that large order breaks, that should then set you up for the continuation, and that then starts to target 15s, 16s, 18s area, and then the much larger continuation over the following days. But that's going to be how people are thinking about this now. We're nearly 5 minutes after the decision. Markets have steadied up. This is where the liquidity comes back. You see how much thicker both markets are already. Liquidity's come back. The T-note's not progressed beyond 8, but we are still seeing it holding up at the highs, whilst the S&P, every time it ticks even a few ticks higher, begins to struggle. As a result of the S&P struggling, what you'd be looking for now is more of a pullback situation, waiting for the market to drift backwards to try and get in. So this is where you're trying to apply your more passive entry to this trade. Remember, this is a market that's running into obstacles. What you don't want to be doing is buying into the highs as it runs into hurdles, whereas the T-note, just trading through 08s now we're getting to a situation where we could be looking for a further continuation. Doesn't do it straight away, so this then again is where you're going to be falling back now. We've had a bit of time to consider what's been going on. It's time to now start thinking, okay, we've got a bit of a pullback. Where exactly do I put my stops? At what point do I think I'm actually going to be wrong on this? And for the S&P, where I'd be thinking now is somewhere below 36s. For the T-note, you're still going to have to see, it's not so clear structurally, maybe even as far as 03 before you really start to feel that you're actually wrong on the trade. Yes, we've seen a little failure above 08s, and we're now looking for this volume to build. As long as you're not seeing any reason to be exiting the trade, you've still got valid reason to stay in it, and look at it from that point of view, particularly when you're playing a continuation type move. If you're looking for this continuation move, what you should be more looking for is points where you would be wrong on a pullback, not necessarily reasons to get out on a move up. If you go for reasons to get out on a move up, this will probably have got you out quite quickly around 08s where you saw that first large order. But having considered the structure, having looked at the larger move that is potentially on for the T-note, this is where you can look at the 08s and think to yourself, well, yes, it's providing a bit of a hurdle, but what it's not doing is suggesting you need to get out. And as long as we're managing to sustain this move higher, as long as we're managing to hold above 03's area where you've got that little dip in volume, then you should be fine. The S&P, on the other hand, has moved up, broken 41.25. We saw a little bit of resistance, a bit of absorption coming in at 42.5, and we're now starting backing off. So from the S&P point of view, you'd want to be out as we come back below 41s, and then reassessing and considering the buy from around the 37 area. Back into that low volume, you could see that dip in volume between 37.5 and 36.5. Also, you can see a further dip in volume below 35.5. So if you are then trying to play along in the S&P, that's the area to be looking to buy from. And as you see from the chart, we get this pullback into that zone before we get one more attempt at 43, which doesn't again manage to break. The T-note at this point steadily consolidating, not sort of pushing on, no real aggression in this market, but this is exactly the point. If you're going to have a steady continuation type move, you don't need to see it exploding higher. More what you're looking for is a steady accumulation higher, shifts value up, and sets up a further continuation. Here's your S&P pullback. So this is where you'd now be looking, if you're not in a trade, to perhaps enter a passive continuation trade. If you are in a trade, this is the point to add and the place to have your stops below. So into the S&P now, looking for this steady move up. We've seen a couple of times 250 lot come on the offer. It's now been taken out and we're starting now to push up once more. The T-note, much like previous moves in the S&P, when the S&P first started to move higher and had bigger washbacks, the T-note on the other hand has stuck very much towards its highs. Trades back towards 6.5, not far enough to be willing to get out, not any reason to be worried about your position here. The S&P on the other hand puts you under a bit of pressure, but if you're maintaining that this is a passive entry for a further continuation to new highs, you're still in a safe position here. So now it's a case of waiting. That we're now 10 minutes after the event. This is where moves do become a lot more steady, and this is where the continuation moves then start to take hold. The S&P not having such a strong continuation argument is then more likely now to find it harder and harder to go higher, whereas the T-note consolidating back at around 6s is beginning to set up the possibility of a continuation. Your next area to be looking for, as I've said, is up towards the 16 to 18 zone. T-note starts ticking higher once more, S&P is moving off 37, so you're seeing some correlation here. That makes sense. Both markets should be correlating and continuing their moves higher together. The key bit now is going to be what happens when they reach their highs, and what we will see is the difference between the T-note and the S&P. S&P now back up towards its high, or getting up towards 41, so 41.25, remember, was the previous key level. Getting back there, we've just once again had this pullback off that zone. The T-note still remaining around 07 and still maintaining a degree of strength as well. S&P once more tries 41. Can it get through there this time? This is where if you have bought it on the way back, you'd be starting to doubt it a little bit. It's really struggling on any of these moves up, constantly finds a bit of a push back on it, constantly sort of running into these quick flicks back. So now once again up towards 41s, 42s, and it's really struggling to maintain a bid, to maintain the move higher. Every time they buy, the bid moves up and the S&P then gets pushed back. Quick move up towards 42.5. So this is where you're now looking for the S&P to keep on going. You're looking for it to break 43s and then keep the move going. Instead, we don't see that. Once more, you see resistance there. You see that it can't push through that zone. The T-note, on the other hand, now is also starting to approach highs. Back up to 08s, and this is where you'd be looking, particularly with the T-note, having that little bit more strength and that greater scope for a continuation to the upside. You'd be looking for the T-note now to push through 8s, start the next leg of its move higher. So we have T-note bid at 8.5. Now, unlike the S&P, the T-note's not washing back very easily here. The T-note's able to trade at 8.5, put a bid at 8.5, and then start trading into 9. Whereas the S&P has once more traded up towards 43 and once again pulled back from it. So by no means showing the strength that you'd be looking for. Once more back below 41.5. And this is where that continuation element really starts to play. The S&P then sits for a further 20 minutes between 43 and 36s, whilst the T-note continues for the next 20 minutes, pushing on and on and on, all the way up towards 15, eventually up towards 17. So yes, not perhaps as dramatic a move as the S&P, but in terms of the amount of size you can get, in terms of the distance that you can take the T-note relative to what a normal move is, this is still a rather large move for the T-note. It's a move that doesn't push back on you very much. It's a move that stays very stable and continues to drift higher and continues to play out that larger technical play. That's what you're looking for in a market like this. You're looking for that further continuation, that extra push. And this is where, if you've managed to get in on that first move, you can be looking to hold part of your position. We're into a phase where we've got a lot more scope towards the upside. If you've taken that quick early trade, made your money from the smash and grab element of the trade, the getting in very quickly, then you can try and hold on to the rest of your position or a core position for the much larger run higher. What we eventually get is that the S&P eventually does trade up. It does eventually break 43 a long time after the T-note has already reached its highs, but starts to turn back. An hour and a half after the decision, the S&P has completely turned around and moved all the way back. At the same point in time, the T-note is still sitting up around the 14-15 area, maintaining value up in that zone. You can see right now the dynamic of how strong the T-note is compared to the S&P. T-note now pushing new highs, whilst the S&P is still falling back into the range. And all this comes down to the difference in their structure, the continuation element that the T-note has in it compared to the S&P's much more stable, much more range-bound market dynamic. And in fact, actually S&P tilted more towards a move to the downside, particularly on a failure to get above 41.5. So that was the result. Not perhaps the most dramatic in the T-note, but a much more steady move up that you'd be looking to try and capitalize on, get in, and then hold on to that position. Now, as we saw, distinct difference in the nature of the way both markets traded. The S&P on the left, the T-note on the right here. The S&P was much more inclined to have bigger pullbacks, to struggle each time it reached levels to the upside, particularly when it got just around that 41 to 44 level, started to get stuck there, get pushed back on from there. And when it did turn, it would wash back for a lot of prices on the way back. The T-note, on the other hand, though, remained very, very steady. Push up towards resistance at 08, hold it sideways, and then when the move progressed, the progression moved on steadily and then shifted value even higher up to the 123.14 to 15 area. So the strength in these markets, in the T-note in particular, was maintained. This then set up the attack on the 123.18s. The S&P, on the other hand, an hour after the decision was made, was already starting to turn that whole move around. Yes, it did push on. Yes, it made it up towards 28.48, the VPOC, but as soon as it fell back below 28.43.5, that, again, similar to the original example, was a good setup and a good clue for the potential of a further reversal down and a move back through the 36 area and a full retracement of the move. T-note, on the other hand, was more a trend type move whereby it moves higher, consolidates, moves higher, consolidates, and that then sets up and builds forward to the next leg of the move, the further bigger picture daily time frame continuation. What we'll do now is we'll actually go and have a look at the rest of the month, how that traded out for the two, and you can see a very distinct difference in the way the T-note maintained its trend compared to the S&P's very much sideways continuation or sideways reaction following this. Let's go and have a look at those. Okay, so following on from the actual result, or the result of the decision, we then saw the T-note follow a very similar structure. Move higher, so the initial decision move took us right the way up towards the 123.18 area. We then got a sideways consolidation followed by another push up, another sideways consolidation, and again. And this is that steady move that you could have been looking for and expecting over the coming days to move all the way up towards 125. The move stopped 124.31, so a tick shy of the actual sort of full target. But nonetheless, that structure, that poor ground down move, then provides this steady move back up that moves up in small consolidation, breakout, small consolidation, breakout. This is what you could be expecting, and something to not just play for, on the night. The night gives you the opportunity, that big fast move up towards 18, but it was then the continuation afterwards, and this should be something kept in the back of your mind, that larger move is still there, and the shift in policy should be then giving you the clue to be trying to play for this, to continue this move, looking for that steady continuation, looking to maintain, not necessarily maintain a long position, but maintain a long bias and continue to try and play a very similar type strategy to that with which you took the actual initial decision with. What we're going to have a look at now is the complete difference between the T-note and the S&P. Remember, the T-note was the one with the more bullish structure to the upside. The T-note was the one offering up this continuation trade, whereas the S&P not at all in the same kind of situation, and the S&P then once more falls back from highs, runs into difficulty as it meets highs once again. We'll go and have a look at that now. Now the S&P, as you can see, took the decision back within an hour of the initial move. So you can see where the decision's marked off. This move then is completely reversed within an hour, and by the end of the day is totally reversed. What then happens is the S&P ends up sitting in a completely sideways range. It tries once more to go for new highs, and this is because of the fact that the T-note's continuing, the dollar's continuing the move that it's initiated over the Fed, whereas the S&P has already shown the weakness, shown that unwillingness to go higher, and in doing that has then put in doubt any further continuation. So you get one more try up, breaks 28.56, you get a small consolidation looking for a continuation above recent highs. This doesn't come, market falls back below, and then you get a full reversal once more. We then end up with a situation where we sit between 28.47s and 27.90s. Remember, 27.93 was the larger target if we had got a full reversal type move. Didn't happen on the day, on the event, but we have now just fallen into this sideways range. And again, this, rather than being a situation to try and play for any of these, is more a recognition of what had been going on to suggest that this was not a scenario or not a time to be trying to play any kind of larger, more expansive, more sustainable move. This was a time to be sitting back and waiting for the next leg, waiting for a market to show you where it wants to go. In this situation, the S&P had no clear sign whether it wanted to go up or down after the decision. There was fundamental reason to go up, very little technical reason to though. And that then meant that the decision itself becomes relatively insignificant in the middle of a wider range, as this market then waits for further input to then make a larger decision. So that's what you need to be taking from this, and the real key thing is the understanding of which market was more inclined to move. This meant you could stay with the T-note, you'd be more aggressive in the T-note in terms of your expectation of the way it would move, how it would steady up and then move once more. Whereas the S&P, you approach this with a greater willingness to exit trades rather than try and hold on to them, because you're not in a situation or not in a position where a sustained strong move up was so well tilted towards. We'll have a quick recap of technical trades in a moment to wrap up the technical preparation section. So to recap, the technical element or the technical preparation is often one of the most overlooked yet one of the most important elements of going into trading a central bank. Most of the focus goes on what could they do, what would you do in this situation, what are the different permutations that could come out, but not understanding the technical picture that your market has and where it's perhaps more inclined to go, where it's more likely to struggle, immediately puts you at a disadvantage. So this should be up there with all of your other preparation, just as important to be thinking about. Remember, a technical pattern that you may be used to seeing, that you may be very aware of and very comfortable in playing, is likely to resolve much quicker than usual. So you get much larger opportunities here. A trade that ordinarily may well have taken you 2-3 hours to play out can play out in a matter of minutes. With this does mean that your targets increase, likewise your stops do, so factor that into your trading. Make sure that you're not assuming that you can suddenly play a larger technical play with a very, very minimal stop. Yeah, the aim here is that your risk reward is still very good, and so you're able then to take on perhaps a little bit more risk, but being able to take on a much greater reward. And don't lose sight of that. Yeah, there's no point in feeling that you've done well to get 5 ticks very quickly, where ordinarily that would take you some time, when actually the market is offering you much more. It may be offering you 20, 30. So keep that element of it in mind. The most important thing with any kind of preparation is to make sure that you've asked yourself the right questions though. And particularly with the technical side of things, this can be very well structured. And if there's 3 questions and you're only going to ask yourself 3, these are probably the 3 to be thinking about. First up, is there a structure that needs to be completed? Because in the event that you don't get any major decision from the central bank, the market then has the participants in it, it has the volume, is likely then to go and complete that structure. So this is where you need to be thinking about, have you got any unfilled gaps? Do you have any poor lows? Have you got any structure that the market is waiting to complete? Once that decision's out of the way, then the market can free up and go back to finishing off the technical picture that is beginning to be painted. So first up, is there any structure that needs completing? Next, and perhaps the most important of all, how are people positioned into the event? I don't mean this in terms of what's the market pricing. I mean this in terms of, have you had a move in whichever market you're trading into the event? Are people now getting exhausted if they've been buying it into the event in the expectation of a decision that aligns with that view? Are they becoming exhausted? Put yourself in their shoes and ask, what would you do if you were long over the past 2-3 days going into this decision? Would you be looking and expecting to cover on the decision? Would you be willing to buy more? Alternatively, are you seeing positions get accumulated just before the decision? Are people building to try and play a move in one direction? And where could those people get pushed out? Where are the stops likely to be? Where are people going to exit? So the positioning element is a lot about asking yourself, what would you do in this situation? Put yourself in the mindset of someone who's a bit more medium term and ask yourself, what would you do? Why are you in this trade? Or why would you be in this trade? And where would you give up on it? Where would you be intending on exiting that trade? That immediately takes you onto a larger scale sort of time frame, immediately gets you to consider the bigger picture structure. And finally, what's the path of least resistance? Where is this market going to find it easier to go? This means you can pick certain markets for certain scenarios. If you get a dovish reaction from a central bank and you have a bond market that's got a bullish setup, that's perhaps the market you'd be more inclined to trade on a certain decision. What it also allows you to do is understand what strategy then to use if a decision doesn't suit the technical landscape. So if you have a very bullish market but you get a hawkish decision, a bullish market and you get a bearish type decision, not every hawkish decision is bearish. If you have a bullish market and you get a decision that implies a bearish move, how likely is that move to continue? Is it likely to have bigger washbacks in it? What strategy do you need to use to accommodate that? So make sure you're asking yourself those questions, and do it for every market that you're considering trading, or even the markets that are related that you're going to be looking for correlations. So make sure you've done that, those 3 questions. Is the structure to be completed? How are people positioned, perhaps most importantly? And what's the path of least resistance? Make sure you've ticked those off. That way you can go into any decision feeling that from a technical point of view, you really understand where your market could go, and also what perhaps the best market to trade over that event is.